The American rental market isn't correcting, it's disintegrating. Across the nation, a financial apocalypse is unfolding in real time, tearing apart the last refuge for millions who couldn't afford to buy. Vacancy rates have surged from 3% to 7.1% nationwide. Inventory has exploded. Units that once commanded $2,400 now struggle to rent at $2,100. Landlords are slashing prices by $100 a week, desperate to attract tenants who no longer exist. For the first time since 2009, rents are falling nationwide, signaling not relief, but the beginning of a systemic collapse. The illusion of housing stability has shattered completely. What's emerging is a fragile economy where affordability has vanished, power has violently flipped, and entire cities are drowning in excess supply they cannot fill. According to Harvard's Joint Center for Housing Studies, a record-breaking 22.6 million renter households are now cost-burdened in 2025, the highest number in recorded American history. That's 50% of all renters spending over 30% of their income just on shelter. And 12.1 million households, 27% of all renters, are severely cost-burdened, spending over half their income on rent alone. Just 3 years ago, Americans were fighting over apartments, lining up for showings, offering 6 months of rent up front, begging landlords not to raise prices. That chaos is now history. The pendulum has swung so violently that the same cities once choking under rental scarcity are drowning in unsold inventory, desperate landlords, and collapsing yields. How did the nation go from historic shortages to an oversupply crisis in less than 24 months? The answer lies in a perfect economic storm that rewired the entire housing system almost overnight. When interest rates exploded from 2.9% to over 7.5%, the home buying pipeline froze solid. Millions who bought at peak valuations suddenly couldn't sell without massive losses. At the same time, corporations began recalling remote employees to physical offices, dismantling the very reason many families relocated during the pandemic. A buyer in Texas, who once worked for a New York firm, suddenly had to return, but their new home in Austin wouldn't sell, so they listed it for rent. Multiply that by hundreds of thousands of households, and you get an invisible wave of new landlords flooding the market. This is the rental market apocalypse, and it's only just beginning. Subscribe to Housing Intel right now for data-driven real estate intelligence that exposes the brutal truth about America's collapsing rental economy. Economists call them accidental landlords, but the truth is far uglier. These are not investors by choice. They're financial hostages. Most are renting their homes below cost, losing $500 to $1,000 every month just to avoid foreclosure. Their desperation has injected hundreds of thousands of additional rental units into already saturated markets, pushing vacancy rates beyond sustainable levels. According to data from Realtor.com, home delistings surged 35% year-over-year in 2025 as sellers pulled properties off the market after failing to find buyers. Houston experienced the most significant spike, with 7% of unsuccessful listings converted to rentals in April alone, marking a 41% rise from the previous year. Dallas reported 5% of its properties becoming accidental rentals, a 32% jump compared to last year. Tampa, Phoenix, and Atlanta followed the same trajectory, flooding their markets with inventory that was never supposed to exist. The phenomenon has already reshaped regional dynamics. In places like Dallas and Atlanta, single-family rental supply has surged more than 35% in a single year, overwhelming traditional investor portfolios. According to the Federal Housing Finance Agency, single-family rental listings have exploded 42% year-over-year in major metros, reversing a decade of chronic undersupply. Institutional landlords, once dominant, are now forced to compete with individuals willing to absorb losses simply to cover part of their mortgage payments. These individuals are not property moguls. They're over-leveraged households, often carrying mortgage payments of $3,000 while collecting just $2,200 in rent. Every listing they add intensifies the imbalance, flooding markets with units priced below profitability, yet still beyond affordability for average renters. As yields shrink and carrying costs soar, what was once a thriving asset class is turning into a liability tsunami. The very structure of rental economics is collapsing under unsustainable debt and false optimism built during the pandemic boom years. As landlords drown in excess inventory, a quiet revolution is unfolding. Tenants, once powerless victims of soaring costs, have seized control of the market. Across the country, renters are dictating terms, demanding reductions, and walking away from overpriced listings without hesitation. Data from Rent.com shows that nearly 64% of tenants who renewed leases this year negotiated lower rents or secured incentives like free parking or waived deposits. The shift isn't emotional, it's mathematical. With supply exceeding demand, leverage has decisively changed hands. In real time, the rental economy has transformed into a bidding war in reverse. Instead of tenants outbidding one another, landlords are now competing for occupancy. Online marketplaces are flooded with units cutting prices every week, a phenomenon once unimaginable in post-2020 America. Cities that once symbolized explosive growth like Austin, Denver, and Tampa are now case studies in deflation, according to Realtor.com data. Median rents in some zip codes have fallen 18% since their 2022 peak, while national vacancy rates have reached the highest level in over a decade. The psychological impact is equally severe. Tenants now recognize that every passing month works in their favor. When expectations shift from scarcity to abundance, urgency dies, and with it, market momentum. Leasing agents report a 40% increase in showing cancellations as renters deliberately delay decisions, anticipating further declines. This behavioral freeze is magnifying the collapse far beyond what raw data suggests. Property owners are now cutting deals that would have been unthinkable just 2 years ago. Free months, flexible leases, utility credits, anything to retain tenants in a contracting market. Yet these discounts come with a steep cost, collapsing yield structures and evaporating investor confidence. The traditional rulebook, location drives price, no longer applies when oversupply exists in every direction. This new power dynamic signals more than a temporary correction. It represents the disintegration of the post-pandemic housing illusion. While landlords fight to fill empty homes, another crisis is erupting deeper in the construction sector. A structural oversupply built on delusion. Between 2021 and 2024, more than 1.2 million multifamily units were launched across the United States, the highest level in half a century. Developers, intoxicated by pandemic-era rent spikes and cheap financing, assumed endless urban demand. What they built instead was an economic time bomb now detonating in slow motion. Markets like Austin, Jacksonville, and Phoenix are the epicenters of this overbuilding wave. According to Matthews Real Estate Investment Services, Austin remains the most oversupplied market nationally, with a 15.3% vacancy rate despite record absorption. In Jacksonville alone, 7,000 new units entered the market in just 12 months, with another 11,000 under construction. Those numbers are unsustainable in a city where population growth has already slowed below 1.5%. Nationwide, the pipeline of new apartment projects exceeds 1 million units, enough to suppress rental growth for years. The irony is brutal. Construction didn't stop when demand did. Because once financing is secured, projects must be completed to satisfy bank covenants. That means thousands of new buildings will keep arriving long after tenants have vanished. Phoenix saw 18,000 units absorbed in 2024, but the addition of 22,000 units kept vacancies at 11%. With 27,000 more units under construction, oversupply concerns loom even larger. Denver posted record absorption, but continues to battle a pipeline of 91,000-plus units, keeping the metro's vacancy rate at nearly 11%. To survive, developers are igniting a price war of incentives. Free rent for 3 months. Zero security deposits. Even luxury giveaways like TVs or gym memberships. These tactics signal distress, not prosperity. Yet even with giveaways, effective rents continue to drop, erasing profitability across the board. Data from RealPage shows effective rental income per unit down 12% nationwide in 2025, with net absorption turning negative in multiple metro zones for the first time since the Great Recession. The overbuilding frenzy didn't just saturate cities with units. It dismantled the illusion of permanent demand. Beneath the collapsing rent prices and construction chaos lies the single most devastating truth: Americans can no longer afford to live in America. The affordability crisis is not a side effect. It's the core fracture splitting the entire housing system apart. Median household income has risen only 12% since 2020, while average rent surged nearly 35% at its peak. Even after recent declines, the financial gap remains catastrophic. To qualify for a $3,000 rental under the traditional 3 times income rule, a tenant would need to earn $108,000 annually. Yet according to U.S. Census data, the median household income stands at just $74,580. That means millions are locked out of the rental system entirely. Landlords are being forced to rewrite the rules of entry. Across multiple markets, the income requirement is being lowered to 2.5 times rent. Credit score minimums are being relaxed. Deposits are shrinking. All measures of desperation, not generosity. In places like Miami and San Diego, property managers report applications from tenants spending over 45% of their income on rent, an unsustainable ratio that historically signals economic distress. At the same time, hidden costs have quietly multiplied. Utility surcharges, maintenance fees, and mandatory renters insurance have turned affordable units into financial traps. The illusion of cheaper rent dissolves once these charges are added back. According to the Bureau of Labor Statistics, overall shelter inflation is still up 26% since 2020, meaning even with falling listed rents, the actual cost of living hasn't meaningfully improved. This affordability collapse is hollowing out the middle class. Teachers, nurses, and municipal workers, once the backbone of stable neighborhoods, are being priced out of the very cities they serve. The result is a new geography of inequality, booming vacancy rates in downtown luxury towers and growing overcrowding in distant, decaying suburbs. Nearly 21 million U.S. households now spend more than half of their income on rent, the highest ratio in recorded history. While long-term rents crumble under oversupply, the short-term rental empire is disintegrating under its own excess. The speculative gold rush that turned family neighborhoods into miniature hotels has reversed violently. Airbnb occupancy rates have plunged from 57% to barely 49%, a nationwide collapse unseen since the pandemic lockdowns. Behind those numbers lies a brutal truth. The math that sustained the short-term boom no longer works. Operating costs have exploded. Insurance premiums for vacation rentals are up more than 280% since 2019, while maintenance, cleaning, and compliance fees consume nearly 40% of gross income. Cities from Los Angeles to New York are tightening restrictions, imposing heavy fines up to $30,000 per violation, and enforcing stricter licensing laws that wipe out small hosts overnight. The speculative class that once dominated social media with Airbnb passive income narratives is now vanishing quietly, forced to sell or convert properties into long-term leases at steep losses. The scale of saturation is staggering. Phoenix went from 5,000 short-term listings in 2017 to over 21,000 by 2025. Austin and Nashville followed the same trajectory, with more short-term units than hotel rooms. As occupancy rates fall and nightly prices collapse by 25% or more, most hosts are discovering they can't even cover mortgage payments. The short-term rental market, once hailed as democratized wealth creation, has transformed into an engine of financial ruin. The fallout extends beyond individual owners. The mass conversion of failing Airbnbs into standard rentals is injecting millions of additional units into an already flooded housing pool. Analysts estimate that even a 10% conversion rate could increase U.S. rental supply by 200,000 units, enough to erase any chance of stabilization for years. This influx crushes margins for traditional landlords and amplifies the deflationary spiral gripping the entire sector. Short-term greed has triggered long-term damage. The fallout from collapsing rents and overbuilt markets is now hitting the final layer of the housing pyramid: investors. What was once the most stable asset class in America has turned into a financial sinkhole. The same investors who fueled the pandemic-era housing frenzy are now drowning in negative cash flow, rising costs, and vanishing equity. According to Redfin data, nearly 18% of all investment properties purchased since 2021 are now losing money every single month. The arithmetic that once justified aggressive leverage no longer holds. Property taxes have jumped an average of 19% nationwide since 2020. Insurance premiums have tripled in disaster-prone regions, and repair costs have soared by over 30%. For a single-family investor, that means every vacant month or price cut destroys profitability. Even institutional funds that once boasted guaranteed yield models are quietly revising expectations downward, with some reporting effective annual returns under 2%, barely above inflation. The pressure is compounded by refinancing risk. An estimated $1.5 trillion in commercial and multifamily real estate loans are set to mature by 2026, much of it financed at ultra-low rates. Now those loans must roll over at 6 to 8% interest, transforming modestly profitable portfolios into high-risk liabilities overnight. Delinquencies on multifamily debt have already doubled compared to 2022, signaling the early stages of a credit contagion. Private equity-backed landlord groups are quietly offloading assets in secondary markets, often at 10 to 20% discounts, just to generate liquidity. Institutional buyers that once dominated suburban development pipelines have frozen acquisitions entirely. The irony is that Wall Street, which once promised stability through scale, is now accelerating volatility by exiting en masse. The ripple effects reach pension funds, REIT investors, and everyday retirement accounts tied to housing-backed securities. The illusion of real estate as a guaranteed hedge has shattered completely. In a deflating rent environment, appreciation no longer masks operational losses. The collapse in the rental market is no longer confined to real estate. It is bleeding into the broader economy, triggering secondary failures that most analysts still underestimate. Housing is not just shelter. It is a core pillar of employment, municipal finance, and consumer spending. When this sector implodes, the aftershocks ripple through every layer of society. Construction jobs are the first casualties. With new development stalled and existing projects struggling to fill units, More than 250,000 construction-related positions have vanished in the last 12 months. Manufacturing demand for materials like lumber, concrete, and steel has dropped by double digits, dragging entire supply chains into contraction. The slowdown extends to local economies that once thrived on real estate momentum. From electricians and landscapers to hardware stores and furniture retailers, each empty apartment represents not just lost rent, but lost economic activity cascading through multiple industries. Municipal budgets are next in line. Property taxes, which fund nearly half of all local government revenues, are falling as valuations decline. Cities dependent on high-rent developments such as Austin and Miami are reporting revenue shortfalls that threaten essential public services. Lower property income means fewer infrastructure projects, hiring freezes for teachers and police, and mounting fiscal deficits. The housing crash has quietly transformed into a municipal finance crisis, one that few city councils are prepared to confront. Regional banks are also being exposed. Many hold substantial portfolios of multifamily construction loans and investor mortgages now at risk of default. Rising vacancy rates mean shrinking collateral values, forcing institutions to increase loan loss reserves and restrict lending. The feedback loop tightens credit availability, choking small businesses already struggling with inflation and reduced consumer demand. Consumer psychology completes the contagion. As rents decline, so do expectations for asset growth. Households reduce discretionary spending, saving more out of fear. Retail sectors dependent on housing confidence, appliances, renovations, and home goods are entering contraction. The economic pulse of the nation slows as one market drags down many. What began as a rental correction has evolved into a systemic contagion, eroding the foundations of local economies. The rental market apocalypse has dismantled the illusion of perpetual growth and revealed the hierarchy of survival within America's housing system. The winners in this reversal are not the wealthiest. They are the adaptive, those who recognize that leverage and optimism no longer guarantee security. For landlords, the age of effortless profit is over. Survival now demands price realism, tenant cooperation, and cost discipline. Vacancy is the new penalty for greed. Those who refuse to adjust will watch equity evaporate faster than any interest rate can rise. For tenants, the brief window of leverage is not a victory, it's a warning. Falling rents do not signify relief. They signal decay in the underlying economy. Lower prices are being fueled not by prosperity, but by desperation. The same forces driving landlords to cut deals are the ones eroding wages and job stability. The balance of power has flipped, but both sides are losing ground under the same economic gravity. Investors face a longer and harsher reckoning. A decade once projected for growth has become one defined by stagnation. Portfolios built on inflated expectations must now navigate years of suppressed appreciation and minimal returns. The lost decade is not speculation. It's arithmetic. Every over-leveraged property, every delayed sale, and every failed refinancing compounds the drag on recovery. The broader economy will not escape this reversal. With construction pipelines shrinking, credit tightening, and municipal revenues collapsing, the consequences will stretch far beyond housing. The American dream, once defined by ownership, now stands on the edge of redefinition. Shelter has reverted from asset to liability, from investment to expense. The data tells a story more powerful than any forecast. A structural reset, not a temporary cycle. What began as a rent correction has evolved into an era of forced realism where markets built on hype return to mathematical truth. The rental market's implosion is not an isolated event. It's the first visible crack in a system overloaded by debt, speculation, and policy failure. This is the great reversal of modern housing, where value dissolves, wealth compresses, and survival replaces ambition. What comes next will not be recovery, but revaluation. If this breakdown exposed the brutal truth about America's rental apocalypse, smash that like button right now. Subscribe to Housing Intel for weekly data-driven intelligence that reveals what mainstream media won't tell you. Ring that notification bell and drop a comment below. How bad is rent in your area? Are you a landlord drowning in vacancies or a tenant finally catching a break? We read every single comment. The easy decade is over. The correction has only just begun.